Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. I'm Pete Wargent, your host, and I'm joined by Chris Bates. Chris, how are we?
Mate, doing very well, Pete. How are you doing on this nice Sunday?
Pretty good. Yeah, I've been following the cricket today over in London, so a little bit sunburned and games in the balance, so we'll see how we go. What have you been up to this week?
Mate, we've finally come out of the sickness coma, I guess, so things are pretty nice and bright again in our world. So, looking forward to the weekend tomorrow.
Fabulous. So welcome to our 2 cent segment. We're on a mission to become Australia's most trusted property podcast. And we take a plain English look at the big 3 property news stories of the week. So every morning at 7 a.m., you'll find this episode waiting for you in your podcast player. And we cover everything really you want to know about the most important headlines of the week, but also we do like to be guided by you, so send us your questions and there's links in the show notes. So Chris, this week the big 3 property news stories, there's always more than we could ever hope to cover, but Domain put out their house price forecast for the next financial year. So we're recording this on the end of financial year 30 June, so we'll take a look at what Domain are forecasting, and actually we'll have a bit of a chat about whether it's even worth paying attention to forecasts and the value in them. Secondly, monthly inflation figures were out this week, which at first blush seem to be really good, but some issues there ongoing. So we'll talk a bit about that. And then thirdly, it's interesting to see when you look at Reserve Bank projections for what's going to happen to mortgage repayments over the year ahead. They're going to be potentially as high as we've ever seen in Australia as a share of household income. So obviously that's going to have some knock-on impacts to the housing market, also for retail trade and potentially a retail recession. So lots going on. So should we kick off first with, story 1, house price forecast from Domain. So should we have a run through those?
Absolutely. Let's do it, Pete.
Well, what did they say? So in bullet points, house prices in Sydney, Adelaide and Hobart will record the largest gains, and prices in Sydney, Adelaide and Perth will reach new record highs. Now, this is a real surprise to me because we've seen the cash rate target go from 0 to 4, and Brisbane house prices are also expected to be close to a new record high. Adelaide and Perth are predicted to avoid a downturn, but just revert to more subdued positive growth. Unit prices are predicted to have more modest growth than houses, but have seen generally a shallower downturn and therefore have held up overall. And we'll see record unit prices in Brisbane, Adelaide, Hobart, and unit prices in Sydney will be close to a new high as in the other cities. So I'm just looking through the forecast. So basically Sydney with the largest growth, but actually, Chris, prices predicted to go up everywhere, every capital city, every region. So what did you think about these?
Look, I think on our other podcast, the Elephant in the Room, we do an annual full of forecast report. And, one of the reasons we do that is forecasting is a bit of a mug's game. I sort of learnt that, harshly in the financial advice world. And, all the, this is what this market's going to do. This is what's going to happen, exchange rates. Every single year, everyone got it wrong. No one really knows what's going to happen. And, there's always another crisis that's happening and, the unexpected happens. And you can go back every year, where it's the recent years, you've got the Ukraine, the COVID, you've got Euro debt crisis, you've got the GFC, you've got on and on and on, right? And so I think it's really hard to do forecasting. There's just so many variables. And even a forecast itself to say that the Sydney market's going to do something, well, that doesn't really matter anyway. You don't buy the Sydney market. You buy an individual property on an individual street. And so some housing markets in Sydney, for example, the top end has been going bonkers in the last, few months. But, that might be completely different to the median areas, and that might be different to the lower end of Sydney, etc. So forecasts are a bit of a mugs game, I believe. I think you've always got to also question where that forecast is coming from. And, there's some real serial offenders, whether they're property bears or the big economists that are always down on the market, or, flipping on a dime. I've seen big economists one day saying a negative thing, then the next day saying a positive thing. And, even in the last week, a big economist was doing that. That's probably the most quoted in the Australian market. So forecasts, I think they're a bit of a waste of time. I do think, though, sometimes you can take some insights from them, though, in terms of getting where they think what markets are going to be stronger than other markets. Look, I think the Domain and REA, they're having a real listings problem right now. And, if I was going to play devil's advocate here right now, what they'd want to see is forecast a bit of stabilization in prices. That, there's not going to be major falls. There's not going to be major growth. It's a safe market to transact in, because that means that people are more likely to want to transact. And so, I'm not a fan of property forecasts. I think it's just too simplistic. It sells newspapers, whether it's positive or negative. It's just the number one obsession in society. People love these things. They're clickbait. But the reality is it doesn't really matter as you, as an individual property person. More likely than not, they're going to be wrong. The banks, for example, got all their forecasts wrong every year. We did a whole back testing of 10 years, and they're pretty much wrong every year. So, don't read too much into these. Really, you want to look at your local market. What's driving it right now? Is it really tight listings? Is demand picking up? Is it stronger demand? Are these people earning more than the current? And so get your local forecast by watching your local market, but don't listen to these mass market things.
I think you might have bagged me out actually one year in your full or forecaster report. I think I can't remember what I said. It wasn't completely wrong, but it was pretty bad. I think, though, to be fair, if you went back 12, 15 months ago at what all of the major bank economists were saying about interest rates, they've been so far wrong, it's not even funny. Now, I guess in their defense, the Reserve Bank was also very wrong, but I think it does go to show that we've seen an awful lot of debate about whether interest rates are going to peak at 4.35% or 4.6%, and really nuanced analysis. But actually, of course, nobody buys a property with a view to selling it immediately for a capital gain. I mean, yes, some people are buying to renovate and flip and so on, but really, if you're looking as an investor, you're probably thinking 5, 10, 15 plus years, and not really trying to second guess what the market's going to do over the next 12 months. So I guess that's one of the things to bear in mind. There's a signal versus noise thing. I think one of the things I've been discussing is this concept of, you're never going to find a situation where everything is right for property. And at the moment, interest rates are the challenge. But when interest rates start falling, there'll be something else. You never get a situation. I think we were talking on the other podcast about the start of the Grand Prix when all the lights go to green. You're never going to have 5 green lights. And at the moment, you've got interest rates as the challenge. But as you mentioned, there's a stock shortage, no listings, record population growth, rents are booming. So there's lots of things in your favor at the moment, but interest rates pulling the other way. But as you said, I don't know, city level property forecast, what does that even mean? You buy an individual property, not the capital city, I guess.
Yeah, and I guess when you're making your property decisions right now, what you want is things that are probably headwinds for the market now that could flip to tailwinds, right? And if you think about buying right now, if you've got the capacity to buy, you're buying under when borrowing capacity has been the tightest it's ever been, 4.5 times income. That's ridiculously tight, and way down from when I started as a broker back in 2013, when you could get 10 to 12 times your income if you knew what you were doing. You've also got when there's still fear around interest rates, and how high are they going to go? How long are they going to stay there? So if those two things flipped, if people were thinking, maybe rates aren't going up anymore, now they're going back down, and they're going back down quite significantly, and then borrowing capacity starts to go up, and you've still got a stock shortage. People only list once prices start to go back up again. And so if those two ingredients happen on low stock, you then absolutely, you'd be much happier than, you don't want to be buying in that market, for example. Very similar thing happened in 2019. The market was really correcting in 2018. Stock numbers were really drying up. real big negative sentiment going into the 2019 election. The Labor lost, Liberals won, rate cuts happened, APRA stepped in, and then bang, prices moved 15, 20% within 6 months. And so, you've just got to be really careful trying to pick this, ultimate time to invest. But the good thing is if you can get a quality asset right now, ultimately there could be things that are headwinds that could tip to massive tailwinds.
Yeah, I'm just looking at these figures here. There's price growth forecast for the Sunshine Coast, but I know from personal experience there's houses that have sat on the market for 6 months, no interest. Asking prices are unrealistic. Now, is that already factored into where the price is today? Are we looking out for the next 12 months? I think you can get way too bogged down in some of these very specific price forecasts, which if you're just buying an individual property or selling one, they don't necessarily mean all that much. And these are forecasts only really to 30 June 2024. Anyway, the fact that they're all positive is a surprise because I think if you'd have asked me a year ago, I would have thought the interest rates would have had a much bigger impact than they have. So, Chris, let's flick on to the second story because that does kind of relate to interest rates. Monthly inflation figures. So previously in Australia, we used to only have the quarterly consumer price index figures, and that was the key driver really of interest rate decisions. There was a lot of talk about from economists and others saying, well, we really should have monthly figures like a lot of other parts of the world. We've now got a monthly inflation indicator, but it doesn't actually cover all of the costs in the basket. So it's only an indicator, doesn't necessarily map across exactly to the quarterly inflation figures. Nevertheless, figures out this week, inflation last month was 6.8% over the year to April, fell quite sharply actually, 5.6% over the year to May. So that was right at the bottom of the forecast range from economists. Now, I guess if you look in other parts of the world, Canada's inflation is now 3.4%. That's come back down. I think US will be at 3% or thereabouts next month. So they're sort of winning this battle against inflation. But Australia, we've kept the borders closed for a very long time. We're obviously much further back on this journey. And I do wonder whether, if you look at the actual core inflation figures there, Chris, we're not out of the woods just yet because there's things like rents are going up, building costs are high. I think anyone who's renewed an energy bill recently or an insurance policy would have noticed there's some punchy price rises still around. And if you look at market pricing, well, potentially, let's look at as I sit here today, markets are looking at a terminal cash rate of about 4.5%. So still potentially one or even two interest rate hikes before interest rates start falling in 2024. So, Chris, what were your thoughts on inflation, where we might be looking ahead? I mean, obviously, there's potentially some stickier parts to inflation. It's not all about fuel prices and things that are falling. There's some things that are still potentially rising.
Yeah, I'm not going to sit here as it leads on to our last question around forecasting where rates are going to be or what inflation's going to get to, etc. Ultimately, though, that inflation number coming down is good news, right? It's good news for people who have got mortgages that are, dealing with more and more rate increases, right? Yeah, I think in the UK, you know this better than me, Pete, but I think it's more of a stickier problem. They're getting a wage price spiral problem. But even though we've got very low unemployment, we're not getting that wage increase problem where, we're getting this spiral. Everyone's asking for more and more salary increases and it's, leading to more and more inflation. I do think rental inflation is a real issue. We can see investors absolutely coming to us in force. And I think that they're potentially considering selling. And if they most likely sell, they're going to sell to owner-occupiers, I would say, first home buyers. And that's only going to further exacerbate the problems in the rental market. And so together with more migration, et cetera, I do think that problem's going to be quite sticky. I think that, a lot of mortgage holders are making cutbacks. I think the last two rate increases, there's been a real mentality shift is that let's really make some cutbacks now. And I think that's really going to start biting with the fixed rates coming off. But, that doesn't mean that a person with a low mortgage, house is worth, $1 million plus, they've got a mortgage of 200,000-300,000, higher interest rates don't really hurt them that much. They're on top of their mortgage, they're earning good money. Are they going to stop spending? Probably not. A person with no mortgage, are they going to stop spending? A retiree, are they going to stop spending? Well, no, they've probably got more money on their investments now because it's in cash. Is a 25-year-old that hasn't got a mortgage, are they not going to go out and, and do things with their friends and travel and things like that? Probably not. They're probably going to keep spending if they've still got a job. So I think it's a real issue. It shows that interest rates really only hit those bigger mortgage holders, but those mortgage holders absolutely are making cutbacks. And so it's heading in the right direction, but obviously we're not out of the woods. And, that's why rates have been keep going up, right? And it's really trying to kill this, get the genie back in the bottle. It's a big problem. But I would say that around the world, other countries are winning at it. If you look at, like you say, US and Canada, but some countries are really struggling. And so it's, that would be my observation right now.
Look at some of the component parts. Building cost pressures were out of control last year. I think for new dwelling prices at one stage last year, 22.6% increase. Now, even now, we're still at nearly double digits increases year on year. It does seem to be finally calming down, though. So that's good news for inflation. But the construction industry, we've seen 2,100 insolvencies over the financial year or thereabouts, about double what it was last year. So that's a real issue in the industry. But I think, Chris, for people wanting to buy or build a new home, I mean, it really is getting smashed by these higher interest rates. The AFR had a piece out this week. Building pipeline in wealthy suburbs hits rock bottom. Economists have warned a slump in building approvals is poised to push property prices and rents higher, with the pipeline in affluent parts of Sydney and Melbourne mired at extremely low levels. They've just thrown in some stats here. This is AFR research. 88 homes were approved across the suburbs of Leichhardt, Marrickville, Sydenham and Petersham in Sydney's inner west over the 12 months to April. So basically nothing. Only 142 dwellings approved in Sydney's inner city in the 12 months to April. That's basically 0.1% of the region's dwelling stock. Manly, there's never any increase in the dwelling stock, 96 approvals, and only 155 across North Sydney and Mossman, which, when you think what things were like 10 or 12 years ago for approvals, that's just an incredible decline. So, yes, there's lots of other stats. Sydney's eastern suburbs, inner west, Lower North Shore, Northern Beaches, and the equivalents in Melbourne's inner city and some of the blue chip areas. So I guess this is the thing, Chris. Yes, we can second guess all day long about where the cash rate is going to peak and when it might come back down, but it's absolutely smoking the building pipeline, particularly it seems in some of those wealthier areas.
And these are just approvals. These aren't let alone what actually gets commenced and actually what finishes, right? And so there's a huge undersupply problem. It makes sense, right? Developers are really finding it hard to sell them. They're finding it hard they can't sell them off the plan. You can't get finance. You don't really want to do it right now because you've got this land. You might have a little land bank and hard to get staff. You might have burnt your buffers because you've had a couple of jobs that have gone bad in the last few years. And so you haven't got the capital to sort of, go at it. I think that's one of the issues with construction companies is that, they're not actually they're not there willing to take risk in this moment because they've burnt their buffers. And so we've absolutely seen a massive drop off in people looking to do renovations. One, because, getting the finance is really hard, the servicing issue, there's an issue with valuations. There's also a desirability. It's not really there. I mean, why would I want to take on this debt when rates are 5 or 6%, a non-deductible debt, just to potentially, if I don't need to absolutely do this right now, let's just put up with our current house. It's not perfect, but let's do it when rates are cheaper. Even yesterday, a client absolutely wants to do a reno to their place, but he just can't justify doing it at 5 or 6% interest rates. And, would rather go and buy an investment. So there's a real pullback, I think, in the construction industry at all levels, from renovations to knockdown rebuilds to, new house and land. I mean, house and land, I think, is still but I think there's been real issues with builders out there. I think there's still good demand, in releasing, land lots, but there's a real pricing problem.
Yes, interesting times for sure, and lots of challenges in the construction and development sector. I think there's still a lot of those fixed rate mortgages still to reset. I think an important thing about interest rate changes is they can take 12 to 18 months to flow through in their entirety. And we've still got all these fixed rate mortgages resetting from 2 to 6%. So there's a big lag effect here. And it may well be that interest rates are paused to see what happens for a period of time. And there's potentially a risk that we head towards recession if the impact of these rate hikes is too significant. So we'll see how this plays out. But it's definitely clear that the current setting is contractionary for the economy. It's going to start bringing down spending, inflation. It's just a question of how long it takes and what kind of pain we might have to go through in the meantime, Chris. So let's rock on to the third and related story, record mortgage repayments. So what happens to mortgage repayments when the fixed rates reset in full? Now, the Bank for International Settlements does all these figures for countries around the world like Canada, UK, US. Australia scores pretty high on debt repayments to household income, and actually significantly higher than countries like the US, where people live there. I mean, there's cities you could choose from all over the US. I'm going to my brother's wedding in Boston, Massachusetts next year, but there's, you could live in Omaha, Nebraska. You could live in, the number of cities. You could live in Texas or California. Australia is not really like that. Basically, we just all live in 3 different places: Sydney, Melbourne, Southeast Queensland, and a few people scattered in Perth and Adelaide. Apologies to the residents of Canberra, Hobart, but it's much more focused in Australia. Now, the Reserve Bank of Australia has done some projections to show the share of household disposable income that will go to debt servicing costs when all these fixed rate mortgages reset. Now, I can't show you the graph on a podcast, but we were down at about 7% of disposable income. The record high was about 9% in 2011, but it looks like by the end of next year, we could be somewhere close to 10. Now, it doesn't sound a lot, 10% of disposable income, but I guess, Chris, this isn't shared equally across the economy, and some households are really going to feel the pinch on that. So that obviously that doesn't sound a lot, Chris, but it's not shared equally across the economy, and some households are obviously really going to feel the pinch, especially those with high leverage.
Yeah, I think the problem with like aggregate data like that is that, 10% would be fine if everyone was on 10%, but some are on 30, some are on 40, some are on 50. I think the point around sort of people coming off fixed rates is that generally speaking, that'll go to a variable rate. You could refix. When you go to a variable rate, you've got to be careful. Like ideally, you want to get that on a very good variable rate, like similar to what your other variable loan is. But there's something called a revert rate. So unless you negotiate that rate with the bank, you can get stuck on a pretty poor variable rate. So be really careful when you come off. The reality is, though, banks have been very good at, retention, really, making sure that their borrowers coming off fixed rates are given good variable rates. The banks are on the front foot here. You should be getting calls from the bank to say, hey, your fixed rate's coming off. What do you want to do? We can give you a new fixed rate. This is the variable rate you're going to go on to. So that's what that happens. People have been making cutbacks, even if they haven't come off their fixed rate yet. People aren't ignorant to say all of a sudden they've got this fixed rate coming off and we're just going to make change when that happens. People have been taking advantage of being on a lower mortgage repayment all the way through, when 2% rates were, people were building up buffers in offset accounts. And so, yes, there's people who live month to month and got nothing in buffers. But then a lot of the people with bigger mortgages were saying, hey, I know these rates are going to, particularly when they started going up last year, we need to start building up a buffer. And clients who have even fixed next year are coming to us and saying, what exactly is my repayment going to be? I need to start preparing for that now and getting further ahead. Because rates are going up. So, I mean, that's the reality is, though, it's that, it's the disposable income to mortgages is much higher. And that's ideally what they're trying to achieve right now, is that people are having to take a lot of money out of the economy that they could be spending in other things that they're just paying towards their mortgage. But on long-term levels, it's not like it's a ridiculous number, right, Pete? And it's just going to really hit the people who took on a lot of debt in recent years. But as a whole aggregate, it's not that much. It's just those 2021, 2022 buyers who particularly leveraged up. They're the ones who are going to hurt. I think the fixed rate cliff as well is a lot of people who fixed had small mortgages. So, they had because all the banks were offering ridiculous rates. If you had a $200,000, $300,000, $400,000 mortgage, you might have fixed your loan. But that mortgage might only be one times a couple of times your income, right? It might be a small mortgage compared to your income. It doesn't mean that everyone who's fixed has huge mortgages. It's just not the reality. It's only a small portion of those and they're the ones who bought in recent years.
One of the things that the Bank for International Settlements misses, and I know this because I've actually spoken at an event where they had economists there. They do a lot of stuff at the sort of headline or macro level, but they don't really understand necessarily what goes on at the local level. And one of the things that in the Reserve Bank's numbers that was really noticeable is that interest repayments actually aren't that high. And the reason for that, I think, is that, well, we've got very large buffers, mortgage buffers in Australia. This is kind of a uniquely Australian setup. It doesn't happen all around the world. We've got lots of people with very large mortgage buffers. Personally, I've got clients who've got a couple of million of mortgage debt fully offset. They've got balances just sitting there.
Yeah.
So I think that's one of the reasons that the headline numbers can look alarming, but the interest repayments aren't actually that high because of buffers. I think there's been another big change since around 2017. If you went back before the macro-prudential measures came in, about 40% of Australia's mortgages by value were on interest-only terms, which was extraordinarily high. And it wasn't just investors at that stage. There was owner-occupiers doing it as well. I think regulators decided that was a potential systemic risk. It absolutely smashed the value of interest-only mortgages now, largely by having a higher mortgage rate for interest-only mortgages. That was one of the mechanisms. They also put a cap on what banks could do. So now it's only really, we're getting close to about 10%. It's an enormous shift in the landscape. I wonder whether at some point, whether interest-only mortgages might start to make a comeback, if not already, Chris. It seems that at least some of the limits there aren't in place now, and potentially more sort of lenders going forward might be a bit more amenable to interest-only loans.
Yeah, I think it's going to be interesting to see if APRA basically say to the banks, look, you don't need to hold additional capital for interest only on homes. I think they've made it really unenticing for the banks to offer interest only on homes. It's really hard to get it, the rate, and it's all non-deductible debt. That higher interest doesn't really make sense. Possible, but it's not it's not easy to get interest only on homes. Interest only investments, ridiculously easy. You can't, when I started in broking, you could get 15 years interest only on homes and investment properties. And some people have still got those loan contracts, right? Where, they've on a home loan, it's interest only, and they don't have to go to principal and interest for another 6 or 7 years, etc. So, but yeah, usually you can get it for 5 years. Some banks like ANZ will do it for 10 years. On investments, etc. So yeah, I do think for investors it makes a lot more sense. A, it's tax deductible, and B, you don't want to be paying them off when you've got home debt, etc. So, but you're right. Like it made sense if you knew how to manage your money back in sort of 2015. You would go interest only on your home because there was no cost to benefit to go principal and interest. It was the same rate, and you put your money in the offset account because then you're building buffers, and so and that made a lot more sense. But you can't do that nowadays because of it's hard to get interest only on homes, and it costs you more money even if you can get it.
There is a potential risk of a retail recession. So as all these fixed rate mortgages reset, people on higher mortgage repayments, people with existing loans are seeing their interest rates go up. Retail figures were actually out this week, a 0.7% increase, which was stronger than expected for the month, but it does come off the back of a number of weak months. And actually, retail turnover is actually lower on a seasonally adjusted basis than it was back in October. And of course, we've seen retail prices increase over that time, and we've got record population growth. An interesting little tidbit of information. Only a month ago, as we sit here today, Australia's population clock ticked past 26.5 million for the first time. But recent population growth figures have been, quicker than expected. And the population clock has now been revised up all the way to 26.6 million. So, I mean, these figures are estimates of the resident population, but there's, in the space of a month, there's 100,000 more people in the country than we thought only a month ago. I mean, if you take those figures at face value, an extra person every 47 seconds, somebody with a better calculator in their head than me can work that out. But what's that population growth of 670,000 per annum at that kind of speed? So, yeah, I mean, it's hard for retail figures to go backwards when you're getting that level of population growth. And no wonder we're getting dwelling shortages. Now, this will, I guess, become a political issue at some point, Chris, because people are starting to get pissed off, frankly, reading about all these record population growth figures. And it's creating pressure on infrastructure and housing. And actually, to some level, this might be sort of contributing to the inflationary figures. The retail figures seem to suggest people are still eating out, cafes, restaurants, takeaways. I guess that might be the oldies, though, that don't have the mortgages.
Yeah, I mean, I remember when it was in COVID and there was no migration and everyone was talking about property prices are going to fall. And I was sort of in my head going, yeah, they're going to fall for a bit and then they're going to bounce back really strongly and they're going to play catch up and they're probably going to let more people into the country than they did prior. And, that's exactly what's happened, right? It's been a massive bounce back, better than people expected. Everything from their unis and tourism, etc. So, and I do think that that's going to create issues, everything from infrastructure to, the housing market in particular. I think that's the rental crisis. I think it's really biting people. And even people who have got properties at the moment, they don't want to sell because they don't want to go back into the rental market. So that's stopping them even upgrading because they're like, what am I going to do? I've got to buy before I sell. I don't want to do that. I can't find something, but I can't sell because I can't go in the rental market. It's like, it's creating all sorts of issues. So yeah, I think this is going to be a story that we start talking about more and more.
In the population growth story, I just saw some figures from Canada out earlier today. The population growth there is crazy high. You're looking at sort of 1 million plus kind of growth. And I think just more broadly, so there's a number of countries around the world. If you look at places like South Korea, my brother's lived there for a decade. There's not really any immigration except for the odd expat like him. And population growth is expected to stall. And then the population is basically projected to halve over the course of this century because the fertility rates are simply too low and there's no immigration. There's other countries like Japan facing the same issue, China, there's all kinds of countries. And I think a number of developed countries have recognized this. If you look at Australia, Canada, UK population growth is currently running at, net immigration of over 500,000. New Zealand's on the bandwagon too. So I think, look, this is probably a whole debate for another day. There's potentially some benefits to a smaller population. I noticed in some regional areas of Japan, it was in the news today, you can pick up a house for free, more or less, but it comes with its own challenges as well. I think, if you're growing productivity in a smaller population, then yeah, sure, GDP per capita might keep increasing, but there's all kinds of other issues if you don't have population growth, lack of entrepreneurship and innovation. It creates a massive issue with dependency ratios, puts a lot of pressure on taxpayers. So it looks to me like, yes, politicians are going to be under some pressure to manage population growth, but it's clearly the policy because look at the projections out for 5 years, 2.2 million, enormous. And I suppose the other thing as well, Chris, is that global capital is much more fluid than it used to be. And with a couple of years where there was no migration of high net worth individuals, as we talked about last week, now we're seeing the highest migration of net worth individuals on record, and that's expected for the next couple of years as well.
Yeah, and ultimately, we're not really focused too much. I do think that there's ultimately a longer-term play of a big Australia, right, and more people coming to Australia. I think, don't quote me on this, but I think in Japan, they sold more nappies for older people than they did for younger people. Something my mum told me, so take it with a bit of
That's an unbelievable stat. If that's true, that is quite incredible.
Yeah, that's right. So I'm not sure my mum said it, so I'm not sure if she read it on an article, but
quote your sources.
It's a good way to finish this episode, Pete. And hopefully send all your questions through. And what's happening in your weekend this weekend, Pete?
Just more cricket, 5 days of cricket, and then it's the Leeds Test next week. So, what about yourself? Any weekend plans?
No, just all family stuff here. Nothing too exciting. Just enjoying not being sick.
Yeah, happy days. Yeah, it's always great to recover from an illness. Yeah, you make you appreciate it all the more when you're not feeling crook. So thanks everyone so much for tuning in. You can catch me on my daily blog, Pete Wargent Blogspot, or at Pete Wargent on Twitter, where you can abuse me on the socials. Don't forget, you can always subscribe for the Rask podcast on your favorite podcast player, or you can catch us on YouTube, where I'm fiddling with my hair the whole time because it's not timed back properly. Chris, where can people catch you if they want to hear more from you at Blusk?
There's a link in the show notes, and absolutely, just fill in the form, and the team will be in touch, and we'll see if we can give you that clarity. At the moment, it's obviously very stressful times for everyone, buying, selling, renovating. There's lots to be aware of.
Yep, thank you, Chris. And we always encourage you to send us your property questions via the link in the show notes, or even if you just want to say good day. And that is it for this week's 2 cents. Thanks, Chris. We'll see you next episode.
See you next, everyone. Happy Sunday, everyone.
Cheers.